our investment service, Smart Tech Investor, we've developed a model specifically to measure integration. And I'd like to talk about that for a minute because it's really important for our readers to understand it. Our model consists of three variables, one of which has to do with the level of dividends being paid by a company. The second has to do with their amount of operating cash flow. And then the third has to do with the extent to which their strategy is consistent with the long-term, I think as you use the term, endpoints of technology. So let's start with the first piece. Why is it important that a tech company be paying dividends? Why does that matter if they're the growth stocks?
Well, I'll tell you why. And it's very straightforward. If you look back to the car wave, Studebaker was humming along, doing fine, selling cars. Their cars looked as good as anybody else's. Guess what? They ran out of cash. So in the end, they weren't able to innovate and integrate, and then they disappeared from the earth, right? Mm-hmm. So to me, we're trying to find a very straightforward way that no one can lie to you and tell you a great story that makes you believe some tale that's not true. When a company's paying dividends, they have cash. That's the first thing we want to measure, because tech companies that will survive will always have cash.
Yeah, and as a long-term stockbroker, I know that the companies that are paying dividends, that tends to support their stock price, which in turn makes it easier for those companies to access the capital markets. Whereas the companies that pay no dividend at all tend to be more volatile, and during a down market, it's more difficult for them to access lines of credits and other things that they need in order to integrate, to go out and invest in other technologies to remain competitive. And that brings me to the second component, which is the cash flow. Obviously, cash flow is the lifeblood of a company. In the case of integration, how does cash flow directly play into integration?
Well, it's very simple. You're a company such as BlackBerry, you're innovating like crazy. No one doubted that BlackBerry was innovating. But when your cash flow started to ebb, guess what you couldn't do? You couldn't integrate into that stuff. You couldn't actually build it into your platform. I mean, for the 2 years that we watched BlackBerry essentially die, all we heard them talk about was they're coming out with a great new handset and a great new operating system and a great. It took them 2 years to get to where Apple was 3 years ago.
Right.
So there's a very concrete measurement of how you can die as a company: cash flow stopping.
Right. And then the third component, which is the strategy, is really probably the most difficult to quantify, and yet I think it's the most critical. And in our model, we give that the heaviest weight. That's 40% of the score that we give a company. And that's really, quite frankly, all you. I make contributions in other ways, but you're the person evaluating the strategy. What do you look for in a company, and how do you go about scoring that strategy component of the metric?
Yeah, so, ironically to me, the third component is the easiest one, because if you spend 30 years in an industry, it's not like it's new news, right? So how I measure how a company's doing is the same way I measured it when I've worked for these large tech companies in the past. When we make deals with these companies, you would look and sit down with them and say, okay, what is your strategy? How are you going to take this hill? You're taking this hill, how are you going to maintain that lead, right? So you're looking for how are they laying out a strategy, which gets us to an always on, completely untethered, utility-based information technology that's just ubiquitous, right? So it's going to be as cheap as electricity, cheap as water. That's where it's going. How are you, as the supplier, the builder of that technology, how are you getting us there? Because if your strategy doesn't directly talk to that, if you're not talking about cloud, if you're not talking about big data, if you're not talking about mobility, you're not talking.
Right.
So it's actually the easiest part to measure.
Okay, so the three components add up to a potential maximum score of 10. Maximum of 3 points for the dividends, 3 points for cash flow, and 4 points for the strategy. But that in and of itself doesn't really tell us whether or not a company is necessarily a good investment today. Obviously, that's a function of how that company is valued today and whether or not that valuation is too high, too low, or just about right. Is Microsoft to buy at 34, or is it overpriced, or is it grossly underpriced?